Okay, let's unpack this. Welcome back to another deep dive. Today, we are tackling something that is, it's literally all around us.
It really is.
If you're listening to this on your commute, you're driving past it. If you're sitting in an office, well, you're sitting inside of it. If you stopped for coffee this morning, you just did business in it.
It is the backdrop of our entire lives, quite literally. You could say it's the stage upon which the entire economy performs its act.
Exactly. We are talking about commercial property.
Yeah.
And I have to be honest, before looking at these sources, and we have a stack of them today, I kind of just thought of it as buildings that aren't houses, you know?
Right, the simple definition.
Yeah, skyscrapers, strip malls, maybe a warehouse here and there. But when you actually dig into the numbers, the scale of this industry is just, it's absolutely mind-boggling.
It is staggering. To give you a sense of the sheer weight of this asset class, back in 2018, the total value of commercial property just in the United States was estimated at approximately $6 trillion.
6 trillion. That is a number that is hard to even visualize.
You can't. It's an abstraction at that point.
That's not just a sector of the economy. That is like the foundation of the economy. It feels like the bedrock.
It is the invisible engine. That's the best way to think
Yeah.
about it. It's not just bricks and mortar. It is where capital lives.
Oh.
It creates jobs. It defines the entire layout of our cities. And as we'll see later, when we get into the current market data, it is a massive flashing indicator of economic health.
A leading indicator.
One of the biggest.
Yeah.
When commercial real estate catches a cold, the rest of the economy often gets pneumonia. It's that interconnected.
And that is really our mission for this deep dive. We want to take you, the listener, from seeing just buildings to seeing assets.
Yeah.
We want to decode the concrete and the glass. When you walk past a shop or an apartment block tomorrow, we don't want you to just see a facade. We want you to see the cash flows, the risks, and the economic signals that are hidden in the architecture.
Precisely. We are moving from the physical world to the financial world. You have to strip away the paint and look at the spreadsheet underneath. That's where the story is.
So let's start at the very beginning. The most basic question, which frankly confused me at first. What actually counts as commercial property? Is it just anything that isn't a single-family house? Where's the line?
Well, the definition is actually quite broad, but it centers on one specific thing: intent.
Intent.
Yes. Commercial property, which is also known as commercial real estate or income property, is any real estate that is intended to generate a profit.
Okay, profit. That seems simple enough.
Yeah.
But how exactly does a building generate profit? It just sits there.
It sits there, but it works for you. The profit comes from two distinct buckets. First, you have capital gains. That's the classic buy low, sell high strategy you see everywhere.
Right.
You buy a property, maybe it's a little rundown, or maybe it's in a neighborhood that's, up and coming, and its value appreciates over time. Eventually, you sell it for more than you paid for it.
Right, that's the appreciation play. Just like buying a stock and hoping the chart goes up and to the right. Simple enough.
Exactly. The second source, and this is really the lifeblood of the industry, is rental income. This is the cash flow. You own the space, and someone else, a tenant, pays you for the right to use it month in, month out.
Okay, but here is where I got stuck in the research. Let's say I buy a nice little house in the suburbs and I rent it out to a family. I have the intent of making a profit from the rent. Is my little rental house now commercial real estate?
Well, technically, no. And this is where we hit the first big aha moment for a lot of people. There is a very specific, and you could argue somewhat arbitrary line drawn between residential and commercial, especially in the eyes of the United States banking system.
Okay, unpack that for us. Because I see apartment buildings that are clearly for people to live in. That's a residential use, but they are owned by these huge corporations.
Correct. It all comes down to scale. In many U.S. states, residential property is considered commercial for borrowing and tax purposes only if it contains more than a certain number of units.
And what's that magic number?
Usually, it's anything larger than a fourplex.
A fourplex, so 4 units.
Right. So a single-family home, a duplex with 2 units, a triplex with 3, or a quad with 4. All of that is generally considered residential. You can walk into a bank and get a standard 30-year fixed mortgage for it, much like you would for your own home.
So the bank is looking at me, my income, my credit score, to see if I can afford it.
Exactly. The bank looks at your personal income and your credit score to qualify you. It's viewed as a personal investment, just on a slightly larger scale.
But if I add one more unit to that building, if I buy a 5-unit building,
The moment that building has 5 units, just one more door, it enters the world of commercial real estate. The game completely changes.
That is fascinating.
Yeah.
So a giant mansion with 10 bedrooms is still residential,
Mm.
but a small, kind of ugly brick building with 5 little studio apartments is commercial.
In the eyes of the bank and the tax man, yes. And it changes everything about how you buy and own it. You can no longer get that 30-year fixed mortgage.
What do you get instead?
Now you're looking at commercial loans. They have shorter terms, maybe 5 or 10 years, not 30. They often have higher interest rates. And crucially, the bank stops looking at you and starts looking at the building.
What do you mean by that?
They underwrite the property itself. They analyze the income of the property. Can the rent generated by those 5 units cover the mortgage payment, the taxes, the insurance, and still leave a profit?
So even if I'm a billionaire,
Even if you're a billionaire, if the building itself loses money every month, a commercial lender might still say no. It shifts from being a home that you happen to rent out to being a business that has to stand on its own 2 feet.
it's about the scale and the intent. The building has to perform as an economic entity.
Exactly. The regulations tighten, the scrutiny increases, and the financing becomes strictly about the math of the asset, not the wealth of the owner.
Okay, so we've established the definition. It's for profit, and if it's housing, it has to be big enough, 5 units or more to count. Now, the sources we looked at categorized this massive commercial world into 6 specific buckets. I love this because it gives us a mental map to organize the chaos of a city.
It does. It organizes the landscape. It's a taxonomy for the built world. Once you understand these 6 buckets, you can look at any skyline or any suburban sprawl and instantly categorize what you're seeing. It's like putting labels on everything.
Let's walk through them. Bucket number 1 is probably what everyone thinks of first: office buildings.
This is the classic image of business, right? With
Yeah.
the glass tower.
Yeah.
But even within this one bucket, there's a huge range. You have the single tenant property, maybe a small brick building on Main Street owned by a dentist or an insurance agent who uses the whole thing.
Right, the little standalone structure with the lawyer shingle hanging out front.
Exactly. That is a commercial office asset. And then on the other end of the spectrum, you have the downtown skyscrapers. Massive multi-tenant towers housing thousands of workers for dozens of different companies.
The ones with the fancy names, like the Salesforce Tower or
Yeah.
the Bank of America Plaza.
Those are what we call Class A buildings, the shiny glass towers with the marble lobbies and the high-speed elevators. They're the premium product.
And then you have everything in between: suburban office parks, the professional centers. The sources mentioned Class B and Class C buildings. What's the difference there?
It's a grading system based on age, quality, and location. Class A is the best. Class B buildings are a little older, maybe not in the absolute best location, but still very functional and desirable. Class C is the oldest stock, often in need of renovations with lower rents.
Got it. So it's a quality scale. And despite the rise of remote work, which I know we'll touch on later in the State of the Market segment, these are still a dominant part of the landscape.
Absolutely. They are the factories of the knowledge economy. For better or worse, a huge amount of business still happens in these buildings.
Okay, bucket number 2, retail. Now, this isn't just shops, right? The sources broke this down into some really interesting subtypes. It seems like there's a whole psychology to retail real estate.
Retail is fascinating because it is where commerce physically meets the consumer. The real estate is explicitly designed to capture your attention and your wallet.
So let's start with the first one on the list: pad sites. That sounds like a launch pad.
In a way, it is. It's launching a business into the consumer's view. These are usually single-tenant buildings located on highway frontages or right in front of a larger shopping center.
Give me an example.
Think of a standalone bank branch in the corner of a Target parking lot, or a Starbucks or a fast food restaurant with a drive-through, a tire shop right on the edge of a big parking lot. They're on an out parcel.
Got it. The stuff you see right off the exit ramp, you drive by, you see the sign, you pull in. It's all about visibility and convenience.
Visibility and access are everything. They pay a premium for that frontage to be right on the road. Then you move into the bigger centers. Next up, you have power centers.
Power centers, that sounds intense, like a power plant.
Well, it refers to the drawing power of the tenants. These are large open-air centers dominated by anchor stores. We're talking about the category killers.
Big box stores.
Exactly. Best Buy, PetSmart, OfficeMax, Home Depot, Target.
Ah, the Saturday afternoon errand run. You go there because you need something specific: a drill, dog food, a laptop, and you know for sure they have it.
Precisely. They aren't necessarily designed for leisurely strolling. They're designed for efficiency and volume. They are usually long strip centers with a massive sea of parking in front. Get in, get your stuff, get out.
But then to contrast that, you have the lifestyle center.
The polar opposite in many ways.
I feel like I know what this is just by the name. This is where you go to hang out.
Yes. This is a blend of indoor and outdoor shopping. It often tries to mimic a traditional main street feel. Even if it's built from scratch in the middle of the suburbs, you see nice landscaping, fountains, brick walkways.
Maybe a cinema or some upscale restaurants mixed in with the clothing stores, like an Apple store and a Lululemon.
That's the perfect description. It's selling an experience, not just goods. It wants to be a destination.
It's the place you go to buy a $6 latte and walk around looking at expensive yoga pants.
Yeah.
You aren't just running an errand, you're spending your afternoon there.
That's the goal. Keep you there longer, which usually means you spend more money. And finally, in retail, you have the most common type, the grocery-anchored community center.
So the supermarket is the big draw.
The supermarket is the anchor, and then you have all the daily needs services around it. The dry cleaner, the nail salon, the local pizza place, the UPS store.
The neighborhood hub. This feels really stable, maybe even recession-proof. People always need groceries and haircuts.
It's considered one of the most stable assets in retail for that very reason. It's not sexy, but it's consistent. So retail covers everything from that local strip mall to the massive regional shopping malls. It's a huge bucket.
Okay, moving on to bucket number 3, multifamily residential. We touched on this with the 5-unit rule.
Yes. So this category includes your standard apartment complexes. You have garden style, which are those 2- or 3-story walk-ups that are spread out over a lot of land, usually with some green space.
Common in the suburbs.
Very. And then you have the high-rise apartment buildings in the city, but it also includes things people might not think of, like student housing and dormitories.
Oh, that's interesting. I hadn't thought about dorms as commercial real estate, but of course they aren't.
Yeah.
They generate rent, a lot of it.
Huge amounts of rent, usually. Student housing is a very specialized niche within multifamily. You often rent by the bed rather than by the unit.
So 4 students in a 4-bedroom apartment are each signing their own individual lease.
Correct. Which is great for the landlord. If one student drops out, you only have a 25% vacancy in that unit, not 100%.
Right.
And because the turnover is high and guaranteed by the academic calendar, it's a very specific, predictable asset class.
It's a business model built on semester leases, and they're often backed by parental guarantees, which I imagine makes landlords very happy.
It certainly reduces the credit risk. It's a very attractive model for investors.
Okay, bucket number 4. This one feels like the unsung hero of the economy, especially these days. Industrial.
Industrial is the backbone. You're right. For a long time, it wasn't considered sexy real estate. It was just dusty warehouses on the edge of town.
The places you only see from the highway.
Exactly.
Yeah.
But with the rise of e-commerce, it has become the hottest ticket in town.
The Amazon effect.
100% the Amazon effect. This bucket includes warehouses and distribution centers, everything from the massive million-square-foot fulfillment centers out in the countryside to the smaller last-mile facilities in the city where your overnight shipping comes from.
What makes these buildings special? They're just big boxes, right?
On the surface, yes. But they have very specific requirements. They need incredibly high ceilings, maybe 30 or 40 feet, for stacking pallets. They need perfectly flat concrete floors for the robotic systems. And they need dozens and dozens of loading docks for trucks.
So it's not just a box. It's a highly engineered box. And it's not just for storage, is it?
No. It also includes more specialized facilities. Large R&D research and development facilities often fall under industrial. Think about where tech companies build prototypes or biotech firms have their labs.
And there's one subtype that the sources mentioned that I find particularly fascinating. Cold storage.
Cold storage, yes. Essentially giant building-sized freezers.
We aren't just talking about a walking fridge in a restaurant.
No, we are talking about entire warehouses that are refrigerated to sub-zero temperatures. These are cold chain properties. They are absolutely essential for the food supply, keeping your frozen pizzas and ice cream frozen from the factory to the store.
And for medicine too, right?
Crucially, for medicine. Think about vaccines or other pharmaceuticals that need to be stored at very specific, very cold temperatures. The entire supply chain relies on these buildings.
Wow. We don't think about the building that keeps the medicine safe, but without that specific piece of commercial real estate, the whole system breaks down.
And building a cold storage facility is much more expensive and complex than building a regular warehouse. You need massive insulation, specialized HVAC systems, redundant backup power generators, because you absolutely cannot lose power for even an hour. It's a very technical, very expensive asset.
Incredible. Okay, bucket number 5, land. This seems straightforward, but I assume there's nuance here too. It's not just buying a field.
There is. You have investment in raw rural land, often called greenfield land. This is often a speculative play. You're buying land in the path of future development.
So you're betting.
You're betting that the city will expand in that direction. You're waiting for the suburbs to crawl out to you. It might be a cornfield today, but you're betting that in 10 years it's going to be a new subdivision or a shopping center.
A long-term game.
Very. And then in contrast, you have infill land. This is vacant land within an already urbanized area. Maybe it's an old, underused parking lot in downtown that is ripe to become a new condo building.
Infill. I like that term.
Right.
It's like you're filling in the gaps of the city.
Exactly. It's often more valuable per square foot because the infrastructure, the roads, the water, the power is already there. You don't have to pay to run a sewer line 5 miles to get to it.
Makes sense. And finally, bucket number 6, the miscellaneous or catch-all drawer.
The industry sometimes calls this special purpose real estate. It's everything that doesn't neatly fit into the other categories.
So what's in there?
It includes hospitality, hotels and motels. It includes medical centers, hospitals, nursing homes, outpatient clinics.
Which are huge businesses unto themselves.
Massive. And a very popular one these days is self-storage.
Self-storage seems like it's everywhere. There are new ones popping up all the time. Why is that considered such a good business?
It is a really unique asset class because the tenant is just regular people storing their excess stuff. Holiday decorations, old furniture, things they don't have room for. But the operating costs are very, very low compared to, say, an apartment building.
How so?
Well, boxes of old sweaters don't call you at 3 a.m. to say their toilet is clogged.
Right.
They don't complain about noisy neighbors. You don't have to fix leaky faucets or repaint walls nearly as often. There are no tenants to screen, really. It's a very low-maintenance, steady source of rent.
That makes a ton of sense. It's a simpler operation.
Much simpler.
Okay.
Now, before we leave these buckets, we have to talk about how they blur together in the real world. We have to talk about zoning and mixed-use development.
Right, because in a city, you rarely see just a field of office buildings and then a mile away, a field of shops. They're all mixed up. Sometimes they're stacked on top of each other.
Especially in modern urban planning. A single commercial building might have retail on the first floor. That's your coffee shop and your bank. Then floors 2 through 10 might be offices. And then floors 11 through 20 might be residential apartments or condos.
So what bucket is that? Is it retail, office, multifamily?
It's mixed use, and this is all dictated by zoning. Local authorities, your city or county government, have very strict regulations. You can't just open a factory in the middle of a quiet neighborhood. A business must be located in an area that is zoned for commerce.
So the city planners are literally the ones drawing the lines on the map, saying, this corner is for shops, this block is for houses.
Yes. And they have the authority to change those designations, which can massively increase or decrease the value of a property overnight. If you own a piece of farmland on the edge of town and the city rezones it for commercial, you just hit the jackpot. Your land value could go up 10x in a day.
It's like a game of SimCity, but with very, very real money.
Extremely real money.
So we have the map. We know the 6 buckets: office, retail, multifamily, industrial land, and miscellaneous. Now let's transition to the engine room, segment 2, the money machine.
The investment mechanics.
Right, because, as we said at the top, the definition of this property is the intent to make a profit. So how do they actually make money? I'm assuming it's not just collecting a rent check and putting it in the bank.
No, it's much more complex than that. To really understand the profitability of a commercial building, you have to look at the cash inflows, the good column on the spreadsheet, and the cash outflows, the bad column.
Let's start with the good, cash inflows. Obviously, rent is the big one. That's number 1 on the list.
Rent is the primary driver, absolutely. But there are other important streams of income. One of the most important concepts in commercial real estate, and one that totally differs from residential, is operating expense recoveries.
Operating expense recoveries. That sounds like some kind of legal jargon. What does it mean in plain English?
It means the tenant pays the landlord back for the costs of running the building.
Oh, really? So the tenant is paying more than just their rent?
In many cases, yes. It depends on the lease structure. For example, in what we call a triple net lease or an NNN lease, which is very common in retail and industrial.
Triple net. What are the 3 nets?
The 3 nets are property taxes, building insurance, and maintenance. So the tenant pays their base rent to the landlord, but they also pay their proportional share of those 3 expenses.
So if the parking lot needs to be plowed in the winter, the tenant effectively pays for it.
Indirectly, yes. The landlord hires and pays the snowplow company, and then at the end of the year, they reconcile the expenses and bill the tenants for their share. That reimbursement is a cash inflow for the landlord.
That is a fantastic deal for the landlord.
It protects the landlord from rising costs. If the city raises property taxes by 20%, the landlord doesn't care. That cost is passed directly through to the tenant. It makes the landlord's net income very predictable and stable.
Wow. Okay, so what else comes in besides rent and these recoveries?
Fees. All sorts of fees. Parking fees are a big one in downtown office buildings or apartment complexes. You could have vending machines, laundry machines, and apartment basements. Fees for using a clubhouse or a gym.
Renting out the roof for cell phone towers.
That's another great example. Those can be very lucrative. All these little trickles can add up to a significant river of revenue over time.
And then there are the invisible inflows, the tax stuff. This is where it gets really interesting.
Yes, the tax benefits are a huge reason why wealthy investors love real estate. And the biggest one is depreciation.
I've always found this concept so confusing. Depreciation means the building is getting older and less valuable, right? It's losing value. How is that a benefit?
It's what we call a phantom expense. The tax code allows you to assume that the physical structure of the building is wearing out over a set number of years. For commercial property, it's currently 39 years. So every single year, you get to deduct 139th of the building's value from your taxable income as if it were a real cash expense.
But you didn't actually write a check for that amount. No money left your bank account.
Exactly. You didn't spend the cash. So you might have positive cash flow, real money in your pocket from the rent after paying all the bills, but on your tax return, you could actually show a loss or a much lower profit because of this massive depreciation deduction.
So it shelters your real income from taxes.
It's one of the most powerful wealth-building tools there is. You make money, but you get to tell the IRS you didn't, legally. And there are other things too, like historic tax credits. If you renovate a designated historic building, the government gives you incentives.
Okay, that's the sunny side of the ledger. Now let's look at the dark clouds, the cash outflows, the bad column.
Well, the biggest one starts on day one, the initial investment, your down payment. Commercial loans aren't like the 3% down home loans you see advertised. They often require substantial equity.
How much are we talking?
20, 30, sometimes even 40% down in cash.
So if you're buying a $10 million building, you need $3 million in cold hard cash just to get in the game.
Correct. Then after that, you have the biggest recurring outflow. Debt service. That's your mortgage payment. Principal and interest. The bank always gets paid first.
The monthly nut you have to crack.
Then come the operating expenses, the ones that aren't reimbursed by tenants or that you have to pay during periods when the building is empty. Property taxes, insurance, utilities, landscaping, janitorial, property management fees. The list goes on and on. You have to pay the person who fixes the toilets.
And things break. Big things.
That's the next category. Capital expenses or CapEx. This is the oh-no fund. This is for major non-recurring items. The roof leaks and needs to be replaced. The HVAC system dies on the hottest day of the year. The parking lot needs to be completely repaved.
These are big, lumpy expenses that can just appear out of nowhere.
And they can wipe out an entire year's profit if you haven't been saving for them in a reserve account. A new roof on a large building can cost hundreds of thousands of dollars.
And there's a cost to getting tenants in the first place, right? The outline mentioned leasing costs.
Yes, and this is another huge difference from residential. In residential, you might just post an ad on Craigslist or Zillow for free. In commercial, you almost always have to pay a broker a commission.
And how much is that?
It can be a percentage of the total value of the lease over its entire term. So if you sign a tenant to a 10-year lease worth a total of $1 million in rent, you might have to pay a broker a $30,000 or $40,000 commission right up front.
Wow. That's a huge check to write.
It is. And on top of that, you often have to pay for tenant improvements or TIs.
What are TIs?
Let's say a law firm wants to rent your empty office space, but the layout is all wrong for them. They need 5 new glass conference rooms and a fancy new kitchen. As the landlord, to entice them to sign that long-term lease, you might agree to pay for those renovations yourself.
So you're spending tens or even hundreds of thousands of dollars before they even move in and pay you a single dollar of rent.
You are spending money to make money. Always.
Yeah.
You are essentially investing in that tenant's business in the hopes of securing their long-term rent payments.
Now, this brings us perfectly to the concept of risk. You mentioned earlier that risk in this game isn't just Will the building burn down?
No, fire is easy. Insurance covers fire. The real day-to-day, gut-wrenching risk in commercial property is tied to tenancy.
The people inside. The business is renting the space.
Specifically, tenant renewal risk. It's a game of probability. When a tenant's 10-year lease ends, will they sign up for another 10 years?
Because if they don't...
If they don't, you have a vacancy. Suddenly, you have zero rent coming in from that space. But you still have to pay 100% of the mortgage, the taxes, and the insurance for it. And now you have to go out and pay a broker a huge commission to find a new tenant, and then pay for a whole new round of tenant improvements to suit the new business.
So a vacant building is just a cash-burning furnace.
It is toxic. It is the #1 killer of real estate investments. That is why investors look so closely at the creditworthiness of a tenant. A 10-year lease with a Fortune 500 company like Starbucks is worth infinitely more than a 10-year lease with Bob's Coffee Shack.
Because the probability of Starbucks being around and paying rent for the full 10 years is much, much higher.
Exactly. The whole business is about predicting the future cash flows. You're analyzing the timing and the amount of money. What is the probability that the cash will come in when you expect it? And what is the probability of an unexpected outflow, like a major repair, a lawsuit, or a natural disaster?
It's not just owning bricks, it's owning a stream of probabilities.
Beautifully put. That's exactly what it is.
Okay, so we know what the buildings are, and we know how the math works. Now let's talk about how you actually go about buying one. Segment 3, how the sausage is made.
The transaction process.
Buying a house is stressful enough for most people. I have to imagine buying a shopping mall is worse.
It is exponentially more complex with many more moving parts and much higher stakes. It's a rigorous, multi-stage process that can easily take 6 months or even a year from start to finish.
Walk us through the life cycle. Step 1, the search. How do you even find a building to buy?
It usually starts with a broker. In the commercial world, listings aren't always public like they are on Zillow for houses. Brokers are the gatekeepers. They market a property on behalf of the seller, and they identify properties for a buyer based on very specific criteria.
Criteria like, I want a warehouse in Ohio.
Much more specific than that. It's more like, I want an industrial warehouse between 50,000 and 100,000 square feet, built after the year 2000, located within 10 miles of a major highway, with at least a 6% return on investment.
Oh, wow. Okay, so very targeted. And you have different kinds of buyers looking for these things, right?
You have the owner-user. That's the business that wants to own its own building to operate out of, like a manufacturing company. And then you have the investor, the person or company who just wants the cash flow. This could be a private individual or a massive private equity firm like Blackstone.
Okay, so the broker finds a property that fits the criteria. Do they just make a formal offer?
Not usually. They typically start with an LOI, a letter of intent.
The outline called this dating before marriage. I like that.
That is a perfect analogy. An LOI is a non-binding, or mostly non-binding, document that outlines the major business terms before the lawyers get involved. It will have the price, the proposed closing date, the length of the inspection period, the big stuff.
So it's not a legal contract to buy.
Correct. It's more like a handshake on paper. It says, I am serious about buying this property, and here's generally what I'm willing to do. The main benefit is that it saves money. You don't want to pay a lawyer $500 an hour to draft a 50-page contract if you can't even agree on the price.
That's smart. So you agree on the LOI, you've had a few dates, you like each other, then comes the engagement ring.
Then comes step 2, the PSA, the purchase and sale agreement. This is the formal, legally binding contract. This is the marriage contract.
And this is where the money gets real.
Yes. At this stage, the buyer is commonly required to submit an escrow deposit or earnest money. It's a good faith deposit held by a neutral third party like a title company.
How much are we talking?
It can be 1% to 5% of the purchase price. So on that $10 million building, you're putting up $100,000 or more just to show the seller you're not wasting their time.
And then the clock starts ticking on the most important part.
Step 3, due diligence. The detective work. This is the most critical phase of the entire transaction.
What are they looking for? What's in the file?
Everything. Unlike buying a house where you just get a simple home inspection, commercial due diligence is a full forensic audit of the property.
Give me the checklist.
Okay. You review the property financial statements for the last 3 to 5 years. Are the sellers telling the truth about how much money the building makes? You review the rent rolls. Who are all the tenants? How much space do they have? When do their leases expire? And most importantly, are they actually paying their rent, or are they 3 months behind?
You check the vendor contracts, who picks up the trash, who mows the lawn, and can I cancel those contracts or am I stuck with them?
You check the zoning. Is the building actually legal for its current use? Or was it grandfathered in under old rules that could cause problems later? You check traffic patterns. Is the city about to close the road in front for a year for construction, killing your retail tenants' business?
And the physical building itself.
Of course. You hire engineers to inspect the roof, the structure, the HVAC, the elevators. But just as important is the environmental condition. This is huge.
Environmental, like is it a green building?
No.
Yeah.
Like, is the ground underneath it contaminated with toxic waste?
Oh.
This is an absolute nightmare scenario. Let's say you're buying that strip mall, and 30 years ago, one of the tenants was a dry cleaner.
Okay.
Old dry cleaning businesses used very harsh industrial chemicals. If those chemicals leaked into the ground over the years, you have serious soil contamination. If you buy that building, under the law, you become the new owner of that pollution. You are now liable for cleaning it up,
Even though you had nothing to do with it.
even though it happened decades before you were born, and the cleanup could cost more than the building itself is worth. So you always order a Phase 1 environmental report to check the history of the site and look for red flags.
Yikes. So you really have to turn over every single stone.
This is where contingencies come in. The PSA, that legal contract, usually says, I will buy this building contingent on me approving all of this stuff during my due diligence period. If I find a problem, bad soil, a bad roof, a major tenant about to go bankrupt, I can back out of the deal and get my deposit back.
It's your escape hatch. Your get-out-of-jail-free card.
It is. But here's the twist. In a hot competitive market, when lots of people want to buy the same building, buyers might waive these contingencies to make their offer look more attractive to the seller.
So they're saying, I promise to buy it no matter what I find, even if I haven't checked the plumbing yet. That sounds incredibly dangerous.
It's high-stakes poker. You are betting that the risk is manageable because you want to win the asset so badly. You're flying blind.
Okay, so let's say the detective work is done. You didn't find any toxic waste. The roof is okay. The numbers check out. What happens next?
Step 4. Hard money and closing. At a certain date that's defined in the contract, the contingency period ends. At that point, the escrow deposit becomes hard, which means it's non-refundable.
The point of no return.
That's it. If you walk away from the deal for any reason after this point, the seller keeps your money. They keep that $100,000 deposit just for the inconvenience you caused them.
That definitely focuses the mind.
It does. It forces you to commit. And then finally, you have the closing. The funds are wired from the lender and the buyer, the title is legally transferred, the keys are handed over, and you now own a commercial building.
And then the real work begins, actually managing the thing.
Right. Notifying all the tenants there's a new owner, transferring the vendor relationships, and crossing your fingers that the roof doesn't leak the next day.
Incredible. It really is a massive operation compared to buying a house. Now, I want to pivot here. We've been talking about how things work in theory, the buckets, the money, the transaction process, but we have some very fresh, very specific data about what is happening right now in the real world of commercial real estate.
The 2024-2025 snapshot.
Segment 4, the state of the market. And folks, you might want to buckle up because there is some serious turbulence ahead.
There is. Let's start with the most recent data point we have from the sources, the confidence drop in April 2025.
This comes from the 1Q 2025 Board of Governors Sentiment Index. What did they find?
They measure what they call positive sentiment. It's basically a poll of the big players in the industry, the developers, the lenders, the brokers, asking how good do you feel about the future. In late 2024, that number was at a very healthy 126.5%.
Okay, so people were optimistic.
Very, but by April 2025, it had crashed at 87.9%.
That is a massive drop. That's not a dip, that's a cliff.
It is the single steepest drop in confidence since the start of the COVID-19 pandemic. The market got very scared very fast.
And do we know why? The source was pretty specific about the driver for this.
Yes. The source explicitly attributes this sharp drop to the Trump administration's latest tariff policies.
Okay, so let's just report on the mechanics here without taking any political sides.
Yeah.
Why would tariffs on foreign goods hurt real estate sentiment in the U.S.?
It comes down to two things: costs and uncertainty. Tariffs usually mean higher costs for raw materials that are used in construction, steel, glass, lumber, concrete, HVAC equipment. If it suddenly costs 20% more to build a new building because steel is more expensive, developers stop building.
It freezes new projects.
It creates a supply shock and grinds development to a halt. And just as importantly, it creates massive uncertainty. Markets hate uncertainty more than anything. If global trade flows are disrupted, that affects the tenants who occupy these buildings. It affects the warehouses that store imported goods. It affects the retailers that sell those goods. If the tenants' businesses are hurting, the landlords get very worried about their ability to pay rent. So the data from this source shows the entire industry is spooked by this policy shift.
So sentiment is way down. But let's look at the office market specifically. We have a really weird paradox here in the 2024 data.
The office space paradox, yes. If you just look at the headline numbers, the leasing volume, the amount of new office space rented in 2024 actually rose to its highest level since 2020.
Which sounds good. That sounds like a recovery. People are going back to the office. Companies are renting space again.
But there is a huge catch, a massive catch that changes the entire story. The source notes that roughly 60% of all active office leases currently in effect went into effect prior to the pandemic.
Wait, unpack that for me. 60%. Why is that a problem?
It means that more than half of the companies occupying office space right now are sitting on legacy leases. They signed these contracts in, say, 2018 or 2019, usually for a term of 7 to 10 years. They are still paying rent based on the old world logic before remote work became mainstream.
So they might have a giant office that is half empty because everyone is working from home on Tuesdays and Fridays, but they are still stuck in that 10-year lease they signed in 2019.
Exactly. They haven't had to make the hard decision yet about their future space needs. They are just paying rent on thousands of empty desks because the contract says they have to. But as those leases expire over the next few years, we are facing a looming cliff.
A lease expiration cliff.
A massive one. When those companies finally come up for renewal, are they going to renew for the same amount of space?
Almost certainly not. They'll downsize. They'll realize they only need half a floor instead of a whole floor.
Or they might decide to go fully remote and get rid of their office entirely. So that high leasing volume statistic for 2024, it masks this ticking time bomb of expirations. The real pain hasn't fully hit the market yet. We're in the eye of the storm.
That is a scary thought for anyone who owns an office building. And we are already seeing signs of trouble. The source has mentioned distress.
Yes. The data from Real Capital Analytics is pretty stark. It shows that over $160 billion of U.S. commercial properties are currently in some form of distress.
What does distress mean?
It means they are in default on their loan, they're in the process of foreclosure, or the owner is in bankruptcy.
$160 billion. That's not small change. That's a huge number.
It's a very significant chunk of the market that is actively failing to pay its debts, and that number has been rising steadily.
And it's not just a U.S. problem, right? We have data on Europe as well.
No, this is a global issue. Europe is facing what many analysts are calling a debt wall.
A debt wall.
According to the sources, there is $960 billion of debt backed by European commercial real estate.
Nearly €1 trillion.
And here is the kicker. Half of that debt, almost $500 billion, needs to be refinanced in the next 3 years.
Why is that a problem? Can't they just go to the bank and get a new loan when the old one comes due?
Because the entire environment has changed. Interest rates across Europe and the world are much higher now than they were when those loans were taken out 5 or 7 years ago. If you borrowed money at 2% interest and now you have to refinance at 5% or 6%, your monthly mortgage payment could double or even triple overnight.
But your rental income from the tenants didn't double.
Exactly. Your income is flat, but your biggest expense just exploded. So suddenly the math breaks. The building's income can no longer pay the mortgage. This puts massive downward pressure on valuations. If the building can't support the debt, it's worth less. And if it's worth less than the loan amount, the bank has to take a huge loss.
And this matters to everyone because...
Yes. The sources note that the commercial real estate sector secures approximately 4 million jobs across Europe. That's construction workers, architects, engineers, property managers, brokers, lawyers, accountants. If the sector seizes up because of this debt wall, millions of jobs are at risk.
It's all connected. The tariffs in the U.S. affecting construction costs, this debt wall in Europe affecting the banks, the ghost leases in office towers affecting the viability of our downtowns.
It is a very precarious moment. We are in a major transition period between the pre-pandemic economy and whatever is settling in now, and commercial real estate is the physical place where all that tension is being felt.
Wow. Okay, let's try to wrap this up. We have covered a lot of ground today.
We certainly have.
We started by defining the beast. Commercial property is anything with the intent of profit, from that tiny 5-unit apartment building all the way up to a skyscraper. We mapped out the 6 buckets: office, retail, multifamily, industrial land, and the catch-all miscellaneous bucket.
Then we looked under the hood at the money machine, how inflows like rent and those important expense recoveries battle against outflows like debt and the dreaded capex. We learned about the phantom expense of depreciation that shelters income.
And we walked through the anxiety of the transaction, from the dating phase of the LOI, through the detective work of due diligence, all the way to that point of no return with hard money.
And finally, we looked at the storm clouds that seem to be gathering in 2025, the tariff-driven sentiment drop, the $160 billion already in distress in the U.S., and that looming office lease cliff.
It's a complicated picture. It's an industry in major flux.
That's putting it mildly.
So what does this all mean for the listener? Why should someone who doesn't own a skyscraper care about any of this?
Because whether you invest in it or not, you exist in it, and its health affects you. This sector holds trillions in value, that $6 trillion number in the U.S. alone. It drives millions of jobs. And when commercial real estate values drop, it hits the pension funds that invest in these buildings on behalf of teachers and firefighters.
It hits the regional banks that lend to them, which could lead to a credit crunch for everyone.
And it hits city tax revenues.
How so?
If that big office building downtown loses half its value because tenants are leaving, the city collects a lot less in property tax from that building. And that might mean less funding for schools or parks or the fire department. It is the invisible scaffolding of our civic society.
I want to leave everyone with a final provocative thought, building on what we've discussed. We talked about that office paradox. 60% of leases are these ghosts from before the pandemic. And we talked about sentiment dropping sharply due to new tariff policies in 2025.
Right, two separate storm systems.
So here's the question. What happens if those ghost leases finally expire and companies start downsizing en masse at the exact same moment that the broader economy is getting hit by tariff shocks and the pressure of high-interest refinancing? What happens to our downtowns when those two timelines finally collide?
That is the multi-trillion-dollar question, isn't it? Are we looking at a slow, manageable correction? Or are we looking at a genuine hollowing out of our urban cores?
Something to think about the next time you walk past an office tower at night. Look up at the windows. How many of them are dark? And more importantly, who is still paying for them?
For now.
Thanks for joining us on this deep dive. We hope you will never look at a strip mall the same way again.
See you next time.
Stay curious.